The collapse of Lehman Brothers in September 2008 was the financial earthquake that not only rocked Wall Street but sent tremors around the globe, signaling the darkest days of the 2008 financial crisis. But was Lehman's fall the cause or merely the tipping point of a system already on the verge of collapse? Grab your seat because we're diving deep into one of the most gripping stories of financial meltdown: how Lehman Brothers became a giant. Lehman Brothers started its journey as a dry goods store in Montgomery, Alabama, founded by Henry Lehman, a German immigrant. Over time, the Lehman family shifted their focus from retail to commodities trading, particularly in cotton, which became a key factor in their early growth. By the mid-20th century, Lehman had become a significant player in investment banking, helping to finance major corporations and infrastructure projects. Throughout the 1990s and early 2000s, Lehman expanded aggressively into fixed income trading, equities, and most importantly, mortgage-backed securities. At the height of the housing boom, Lehman underwrote some of the largest mortgage-backed securities deals on Wall Street. The firm's aggressive approach to leveraging debt, with a 30-to-1 ratio at its peak, fueled its rapid rise. By 2008, Lehman was valued at over $45 billion, boasting revenues of more than $19 billion annually. However, the seeds of its destruction were sown by its massive exposure to the housing market. Subprime mortgages, the time bomb. Lehman Brothers' aggressive involvement in subprime mortgages was a key reason for its collapse. These mortgages were often given to borrowers with poor credit histories, making them incredibly risky. Lehman securitized billions of dollars worth of these loans into mortgage-backed securities, which were then sold to investors. This strategy worked while housing prices were rising, as the firm generated billions in profits from fees and interest. However, when the housing bubble burst in 2007, Lehman found itself holding billions of dollars in toxic assets that rapidly lost value. With declining home prices and rising defaults, Lehman's mortgage-related investments were increasingly worthless. The firm had amassed a portfolio of $85 billion in mortgage-backed securities, more than 4 times its shareholder equity. Lehman's fate was sealed when it couldn't offload these assets fast enough, leading to a liquidity crisis. Warning signs: cracks in the fortress. Despite warning signs that the housing market was deteriorating, Lehman Brothers remained publicly optimistic. In early 2007, Lehman's stock price peaked at $86.18 per share, giving the firm a market capitalization of nearly $60 billion. Even as the housing crisis deepened, the bank continued to report record profits, assuring investors that it had diversified its portfolio to mitigate risks. Behind the scenes, however, defaults on subprime mortgages were skyrocketing. By the summer of 2007, when Bear Stearns collapsed, investors and analysts began to question Lehman's ability to weather the storm. Lehman's leadership, particularly CEO Richard Fuld, resisted calls to scale back the firm's exposure to the mortgage market. Lehman's last stand: desperate measures. As the housing market crumbled, Lehman took several steps to try to salvage its position. In early 2008, it raised $4 billion through a stock offering to shore up its balance sheet. It also began aggressively selling assets, cutting jobs, and reducing its exposure to residential mortgages. However, these measures were seen as too little, too late. Investors lost confidence in the firm's ability to navigate the crisis, and Lehman's stock price plummeted throughout the year. By June 2008, Lehman posted a $2.8 billion loss, marking its first quarterly loss in over a decade. As the financial crisis deepened, Lehman desperately sought a buyer, engaging in talks with Bank of America, Barclays, and even the Korea Development Bank, but no deal materialized. September 15, 2008, the day of reckoning. September 15, 2008 will forever be remembered as the day Lehman Brothers collapsed, triggering a global financial crisis. With over $613 billion in debt and $639 billion in assets, the firm filed for Chapter 11 bankruptcy, marking the largest bankruptcy in U.S. history. The effects were immediate. Global stock markets plunged, with the Dow Jones Industrial Average falling 500 points in a single day. In the aftermath, credit markets froze as banks and financial institutions became wary of lending to one another. The Federal Reserve and U.S. Treasury scrambled to stabilize the financial system, leading to the eventual creation of the $700 billion Troubled Asset Relief Program. Lehman's bankruptcy also caused ripple effects in other industries, with automakers, retailers, and even governments feeling the pinch. The domino effect. How Lehman's fall spread chaos. Lehman's collapse had far-reaching consequences beyond Wall Street. The Reserve Primary Fund, a major money market fund, was forced to break the buck after it revealed that it held significant amounts of Lehman's commercial paper, causing panic among investors. This led to a run on money market funds, prompting the Federal Reserve to step in and guarantee their assets to restore confidence. The global banking system was also severely impacted, with institutions such as AIG, Merrill Lynch, and Wachovia teetering on the brink of collapse. In the weeks that followed, central banks injected billions into the financial system to stabilize markets, but the damage had already been done. Could Lehman have been saved? The controversy. In the years following Lehman's collapse, a heated debate emerged over whether the firm could have been saved. Some argue that the U.S. government's refusal to intervene, as it had done with Bear Stearns just months earlier, sealed Lehman's fate. However, regulators, including then Treasury Secretary Hank Paulson, have maintained that Lehman lacked the collateral necessary for a bailout. Critics point out that the Federal Reserve had used creative solutions to bail out other institutions, such as AIG, and argue that Lehman's collapse was a policy failure. Regardless of the controversy, Lehman's bankruptcy remains a defining moment in the financial crisis, one that reshaped the global banking system. The aftermath. What changed? Lehman's collapse led to significant changes in financial regulation. In the U.S., the Dodd-Frank Wall Street Reform and Consumer Protection Act was passed in 2010, aimed at preventing another financial crisis of this scale. The act imposed stricter regulations on banks, including higher capital requirements and regular stress tests to ensure they could survive another downturn. It also established the Consumer Financial Protection Bureau to protect consumers from predatory lending practices. In the years since, the banking sector has become more conservative, with fewer risky loans being issued. However, some experts worry that the lessons of 2008 are already being forgotten, as regulations are gradually rolled back. Lehman's legacy. Even today, Lehman Brothers' legacy continues to loom large over the financial industry. The firm's collapse is studied in business schools as a cautionary tale of excessive risk-taking, poor governance, and the dangers of over-leveraging. The mortgage industry, in particular, has undergone significant changes. Lenders are now subject to stricter regulations, including the requirement to verify a borrower's ability to repay a loan before approving a mortgage. However, as the financial industry evolves, new risks are emerging, including the rise of corporate debt and private equity, both of which could pose challenges for regulators in the future. While the financial system is more stable today, the specter of another crisis continues to haunt policymakers. The final act. Pop culture immortalizes Lehman. Lehman Brothers' dramatic fall has been immortalized in popular culture, with its story being featured in movies such as The Big Short and Too Big to Fail. The 2019 Showtime series Black Monday offers a darkly comedic take on the financial world, drawing inspiration from Lehman's collapse. Additionally, the play The Lehman Trilogy, which debuted in 2019, chronicles the rise and fall of the Lehman family over 150 years, highlighting the firm's pivotal role in shaping the modern financial world. These portrayals have cemented Lehman's place in history as a symbol of the excesses and failures of Wall Street. Thanks for sticking with us through this fascinating look at Lehman Brothers and its massive role in the 2008 financial crisis. If you found this video insightful, make sure to hit that like button and subscribe to our channel and click the notification bell so you're the first to know when we drop new videos. Got any thoughts or questions about Lehman's collapse? Drop them in the comments and let's keep the conversation going. Thanks for watching, and we'll see you in the next video.